Question 1. Topic: Premium calculation factors: age, health, gender, marital status. Which of the following is least likely to impact the premium calculation for a long-term care insurance policy in Idaho? A. The applicant's gender. B. The applicant's age at the time of application. C. The applicant's number of dependents. D. The applicant's medical history. Answer: C. The applicant's number of dependents. Explanation: long-term care insurance premiums are primarily determined by factors like age, gender, health, and marital status. Older applicants or those with a history of medical issues tend to have higher premiums. Gender affects rates as women typically live longer and may require more long-term care. The number of dependents, however, is not a factor in premium calculations for long-term care insurance policies, as this type of insurance is individual-based, not family-based. Idaho insurance regulations do not mandate the consideration of dependents when calculating premiums. Question 2. Scenario-based question. Topic: Filing a long-term care claim in Idaho. Ms. Taylor, age 75, has a long-term care insurance policy that includes a 90-day elimination period. Recently, she was diagnosed with early-stage dementia and is now having difficulty with 2 activities of daily living adults. She has started receiving home-based care but has not yet filed her claim with her insurance provider. How should Ms. Taylor proceed in filing her claim to ensure her coverage activates properly? A. Ms. Taylor should wait until the 90-day elimination period has passed before filing her claim. B. Ms. Taylor should immediately file her claim with the insurance company, but understand that benefits will only begin after the 90-day elimination period has been met. C. Ms. Taylor must receive a doctor's certification of cognitive impairment before she is eligible to file her claim. D. Ms. Taylor should file her claim, but the policy will deny any claims for conditions related to dementia. Answer: B. Ms. Taylor should immediately file a claim with the insurance company, but understand that benefits will only begin after the 90-day elimination period has been met. Explanation: long-term care insurance policies in Idaho typically require the insured to satisfy an elimination period similar to a deductible before benefits are paid. In this case, Ms. Taylor should file her claim immediately, so the 90-day waiting period starts as soon as possible. During this period, she will be responsible for the costs, but once the elimination period is over, her benefits will activate. Idaho law does not mandate waiting until the elimination period ends to file a claim, and insurance providers generally encourage early filing to ensure timely claims processing. Dementia is an eligible condition under most LTC policies, and a DL limitations make her eligible to trigger benefits. Question 3. Topic: non-forfeiture options. Reduced paid up, shortened benefit period. Which of the following is the primary purpose of a non-forfeiture option in long-term care insurance policies? A. To allow the policyholder to stop paying premiums while keeping a reduced benefit. B. To reduce the waiting period before benefits can be claimed. C. To enable the policyholder to increase their benefit amount over time. D. To allow the policyholder to transfer the policy to another person. Answer: 8. To allow the policyholder to stop paying premiums while keeping a reduced benefit. Explanation: non-forfeiture options in long-term care insurance policies protect the policyholder from losing all their paid premiums if they decide to stop paying for their policy. The reduced paid-up option allows the policyholder to keep a reduced benefit amount without paying further premiums, and the shortened benefit period option provides a shorter period of coverage with the same benefit amount. These provisions are designed to provide flexibility and financial protection for the insured if they are no longer able to afford the policy. This is a required option for LTC policies in Idaho as per state insurance regulations, ensuring consumers have the ability to retain some level of coverage even after premium payments cease. Question 4. Topic: Idaho-specific requirements for policyholders. In Idaho, long-term care insurance policies must include which of the following consumer protection provisions? A. A mandatory 45-day free look period. B. The right to reduce coverage in exchange for low premiums. C. A requirement to cover all pre-existing conditions from day one. D. A guaranteed renewal provision for up to 5 years. Answer: B. The right to reduce coverage in exchange for low premiums. Explanation: Idaho regulations require long-term care insurance policies to allow policyholders the option to reduce their coverage, such as lowering their daily benefit or reducing the benefit period in exchange for reduced premiums. This ensures that if a policyholder faces financial difficulties, they can maintain some level of coverage without canceling the policy entirely. The free look period in Idaho is typically 30 days, not 45, and pre-existing conditions are usually subject to waiting periods. Guaranteed renewal provisions must allow for renewal as long as premiums are paid, not limited to 5 years. Question 5. Scenario-based question. Topic: Medicaid spend down and look back periods. Mr. Anderson, age 78, has depleted his savings and is now considering applying for Medicaid to cover his long-term care needs. 2 years ago, he gifted $100,000 to his children. If Mr. Anderson applies for Medicaid in Idaho, what impact might this gift have on his eligibility? A. The gift will have no effect on his Medicaid eligibility since it was made more than a year ago. B. The $100,000 gift will disqualify him from Medicaid for a certain period depending on the penalty calculation. C. The gift will reduce his monthly benefit amount under Medicaid but not disqualify him. D. The gift will be considered income and increase his Medicaid eligibility. Answer: B. The $100,000 gift will disqualify him from Medicaid for a certain period depending on the penalty calculation. Explanation: Medicaid has a look-back period of 5 years in Idaho and nationwide, during which any gifts or transfers of assets made by the applicant are reviewed to determine eligibility. Mr. Anderson's $100,000 gift to his children would trigger a penalty period during which he would be ineligible for Medicaid. The penalty period is calculated by dividing the value of the gift by Idaho's average monthly cost of long-term care services. This rule helps prevent individuals from giving away assets to qualify for Medicaid. Question 6. Topic: Inflation protection options. Simple, compound, no inflation protection. Which of the following statements about inflation protection in long-term care insurance is correct? A. Compound inflation protection increases the benefit by a fixed percentage each year based on the initial benefit amount. B. Simple inflation protection applies only if the policyholder's health status changes. C. Compound inflation protection offers higher potential growth of benefits compared to simple inflation protection. D. Inflation protection is mandatory in Idaho for all long-term care insurance policies. Answer: C. Compound inflation protection offers higher potential growth of benefits compared to simple inflation protection. Explanation: Compound inflation protection increases the benefit amount each year based on the current benefit, leading to faster growth over time compared to simple inflation protection, which increases the benefit by a fixed percentage based on the initial benefit amount. This is especially important for long-term care insurance because the costs of care typically rise significantly over time. Idaho does not mandate inflation protection for all policies, but it must be offered to policyholders, especially for partnership policies. Question 7. Topic: Waiver of premium rider. What is the primary function of the waiver of premium rider in a long-term care insurance policy? A. It allows the policyholder to receive a refund of all paid premiums upon reaching a specific age. B. It eliminates the need to pay premiums once the policyholder begins receiving long-term care benefits. C. It suspends premium payments for up to 6 months in case of financial hardship. D. It allows the policyholder to borrow against the policy's cash value without paying interest. Answer: B. It eliminates the need to pay premiums once the policyholder begins receiving long-term care benefits. Explanation: The waiver of premium rider allows the policyholder to stop paying premiums once they begin receiving benefits for long-term care, such as nursing home care or in-home care. This rider ensures that the policyholder is not burdened with premium payments during a time when they may already be facing significant care costs. It is a common feature in long-term care insurance policies and is crucial for maintaining coverage during a period of financial strain caused by long-term care expenses. Question 8. Topic: Non-forfeiture options. Reduced paid-up, shortened benefit period. Which of the following is a non-forfeiture option in long-term care insurance policies? A. Lifetime premium waiver. B. Reduced paid-up benefit. C. Elimination of policy exclusions. D. Transfer of policy ownership. Answer: B. Reduced paid-up benefit. Explanation: A reduced paid-up benefit is a common non-forfeiture option that allows policyholders to stop paying premiums while still maintaining a reduced benefit amount. This option is designed to prevent policyholders from losing all their paid premiums if they decide to stop making premium payments. Idaho regulations require non-forfeiture options to be offered in long-term care insurance policies. Other non-forfeiture options include shortened benefit periods, but there is no option for lifetime premium waivers or transferring ownership of the policy. Question 9. Topic: Claims denials and appeals process. If a long-term care insurance claim is denied in Idaho, what is the first step the policyholder should take? A. File the lawsuit against the insurance company. B. Contact the Idaho Department of Insurance to report the denial. C. Submit an appeal to the insurance company following their formal appeals process. D. Reapply for benefits with a new provider. Answer: C. Submit an appeal to the insurance company following their formal appeals process. Explanation: when a long-term care insurance claim is denied, the policyholder should first submit an appeal to the insurance company following its formal appeals process. Idaho law requires insurance companies to provide a clear explanation for denials and a process for policyholders to appeal the decision. Filing a lawsuit is a later option if internal appeals are unsuccessful, and contacting the Department of Insurance may also be necessary if there is evidence of wrongdoing, but the initial appeal must go through the insurance company. Question 10. Topic: Long-Term Care Partnership Program. Which of the following is true regarding Idaho's long-term care partnership program? A. Partnership policies offer unlimited lifetime benefits. B. Partnership policies allow policyholders to protect some of their assets if they apply for Medicaid. C. Partnership policies automatically include premium discounts for Idaho residents. D. Partnership policies only cover care in nursing homes and not in home care. Answer: B. Partnership policies allow policyholders to protect some of their assets if they apply for Medicaid. Explanation: Idaho's long-term care partnership program allows policyholders to protect a portion of their assets from Medicaid spend-down requirements if they eventually need Medicaid to cover long-term care costs. For every dollar of benefit paid by the partnership policy, a dollar of the policyholder's assets is disregarded by Medicaid, which helps safeguard their savings. This is a key feature of the program, but partnership policies do not offer unlimited benefits, automatic premium discounts, or restricted care settings. They typically offer coverage for both nursing home and in-home care. Question 11. Topic: Benefit triggers for long-term care insurance. In Idaho, which of the following is the most common benefit trigger for activating a long-term care insurance policy? A. The policyholder must be unable to perform at least 2 out of 6 activities of daily living adults. B. The policyholder must be hospitalized for at least 30 consecutive days. C. The policyholder must be diagnosed with a terminal illness with a life expectancy of 6 months or less. D. The policyholder must have a written recommendation from their primary care physician. Answer: A. The policyholder must be unable to perform at least 2 out of 6 activities of daily living adults. Explanation: the most common benefit trigger for long-term care insurance is the inability to perform at least 2 out of 6 activities of daily living adults, such as bathing, dressing, or eating. This is a standard requirement in Idaho and many other states. Hospitalization and terminal illness are not typical benefit triggers for long-term care, and while a physician's recommendation might be required for some claims, it is not the primary trigger for benefits. Question 12. Topic: Elimination period in long-term care insurance. The elimination period in a long-term care insurance policy refers to A. the period during which the policyholder must pay out of pocket for services before benefits begin. B. the time it takes for the insurance company to process and approve a claim. C. the time during which pre-existing conditions are excluded from coverage. D. the period after which the policy can no longer be cancelled for any reason. Answer: A. the period during which the policyholder must pay out of pocket for services before benefits begin. Explanation: the elimination period is the waiting period that a policyholder must satisfy before their long-term care insurance benefits are paid. During this time, the policyholder must pay out of pocket for care. The typical elimination period is between 30 to 90 days. It is essentially a deductible measured in time rather than a dollar amount. The elimination period does not involve claim processing time or exclusions for pre-existing conditions. Question 13. Topic: Qualified long-term care insurance policies. To be classified as a qualified long-term care insurance policy under federal law in Idaho, the policy must A. provide coverage for at least 10 years, B. be guaranteed renewable and offer inflation protection, C. cover only services provided in licensed nursing homes, D. comply with specific consumer protections and offer tax advantages. Answer: D. comply with specific consumer protections and offer tax advantages. Explanation: a qualified long-term care insurance policy must meet federal standards for consumer protections, such as being guaranteed renewable and following specific benefit triggers. Qualified policies also offer tax advantages, such as allowing premiums to be tax deductible within certain limits. These policies do not necessarily have to provide coverage for A set period, like 10 years, or cover only nursing home services are they often include in home care as well. Question 14. Topic: Rescission of long-term care policies. In Idaho, under what circumstance can a long-term care insurance policy be rescinded after being in effect for more than 2 years? A. The policyholder is no longer able to pay premiums. B. The insurance company discovers that the policyholder misstated their age on the application. C. The policyholder committed fraud in the application process. D. The insurance company undergoes a merger and changes its terms. Correct answer: C. The policyholder committed fraud in the application process. Explanation: In Idaho, as in most states, a long-term care insurance policy can only be rescinded after being in effect for more than 2 years if it is proven that the policyholder committed fraud during the application process. Minor mistakes, such as misstating age, would not typically result in rescission but could adjust premiums. Inability to pay premiums or company mergers are not valid reasons for rescinding a policy after it has been in effect for more than 2 years. Question 15. Topic: Premium rate increases. Which of the following statements is true regarding long-term care insurance premium rate increases in Idaho? A. Premiums can only be increased within the first 5 years of the policy. B. Premiums can never be increased once the policy is issued. C. Premium increases must be approved by the Idaho Department of Insurance. D. Premium increases are automatically applied every 3 years to account for inflation. Answer: C. Premium increases must be approved by the Idaho Department of Insurance. Explanation: In Idaho, any premium rate increase for long-term care insurance policies must be approved by the Idaho Department of Insurance. Insurance companies must justify rate increases based on rising claims costs, and these increases cannot be applied arbitrarily. Premiums are not automatically increased for inflation, and policies are not immune from increases after being issued as long as regulatory approval is obtained. Question 16. Topic: Idaho Medicaid long-term care eligibility. Which of the following assets is generally excluded from Medicaid's asset eligibility calculation for long-term care in Idaho? A. The value of a second home. B. Retirement accounts, such as IRAs. C. The value of the policyholder's primary residence up to a certain limit. D. Life insurance policies with a cash value of over $2,000. Answer: C. The value of the policyholder's primary residence up to a certain limit. Explanation: For Medicaid eligibility in Idaho, the value of the policyholder's primary residence is generally excluded from the asset calculation up to a certain equity limit. Other assets, such as a second home, certain retirement accounts, and life insurance policies with significant cash value, are usually considered countable resources. The specific exclusion limits for primary residences can vary depending on the state's guidelines and federal regulations. Question 17. Topic: Non-duplication of benefits clause. What does a non-duplication of benefits clause in a long-term care insurance policy ensure? A. The policyholder cannot receive benefits from more than one insurance policy simultaneously. B. The policyholder must pay for services upfront and then be reimbursed. C. The policyholder can only receive benefits after all other forms of insurance have been exhausted. D. The policyholder receives the full policy benefit amount regardless of other coverage. Answer: A. The policyholder cannot receive benefits from more than one insurance policy simultaneously. Explanation: A non-duplication of benefits clause prevents the policyholder from receiving benefits from multiple long-term care insurance policies for the same claim. This ensures that there is no overlapping of benefits, meaning the total benefit paid cannot exceed the actual cost of care. The clause does not require upfront payment or exhaustion of other insurance, but it ensures that the policyholder is not paid more than the cost of the services they receive. Question 18. Topic: Care coordination services. Which of the following is typically included as part of care coordination services in a long-term care insurance policy? A. Legal representation for Medicaid planning. B. Assistance in finding and coordinating appropriate long-term care services. C. Free medical supplies for home care. D. Cash payments in lieu of receiving services. Answer: B. Assistance in finding and coordinating appropriate long-term care services. Explanation: Care coordination services in long-term care insurance policies typically include assistance in finding and coordinating the most appropriate care services, whether in home care, nursing home care, or assisted living. These services help policyholders navigate the complexities of long-term care, ensuring they receive the services that match their needs. It does not involve legal representation, free supplies, or direct cash payments as part of this benefit. Question 19. Topic: Guaranteed renewability. What does guaranteed renewability mean in the context of a long-term care insurance policy in Idaho? A. The policyholder can renew the policy even if they become disabled. B. The insurance company cannot cancel the policy as long as premiums are paid. C. The policyholder has the right to change coverage limits at any time. D. The insurance company must renew the policy at the same premium each year. Answer: B. The insurance company cannot cancel the policy as long as premiums are paid. Explanation: a guaranteed renewable long-term care insurance policy means that the insurance company cannot cancel the policy as long as the policyholder continues to pay their premiums. However, the insurance company can raise premiums for entire classes of policyholders if approved by the Idaho Department of Insurance. The policyholder does not have the right to change coverage limits at will, and premiums can increase even with guaranteed renewability. Question 20. Topic: Home health care coverage. A long-term care insurance policy in Idaho that includes home health care coverage generally provides benefits for A. Only medically licensed nurses. B. Any family member providing care. C. Skilled and non-skilled care, such as assistance with adults. D. Home modifications and transportation services. Answer: C. Skilled and non-skilled care, such as assistance with adults. Explanation: home health care coverage in long-term care insurance policies typically provides benefits for both skilled care e.g. nursing care and non-skilled care e.g. assistance with activities of daily living or adults. This can include help with bathing, dressing, and mobility, as well as more medically intensive services like physical therapy or administering medication. Home health care coverage usually does not provide benefits for home modifications or transportation, and family members are generally not covered unless they are licensed professionals. The goal of home health care benefits is to help individuals stay in their homes for as long as possible while receiving necessary care. Question 21. Topic: Inflation protection and long-term care insurance. In Idaho, what is the primary purpose of an inflation protection rider in a long-term care insurance policy? A. To increase the premium over time to match rising care costs. B. To automatically increase the policy's benefit amount to keep pace with rising care costs. C. To ensure that the policyholder can purchase additional coverage without underwriting. D. To provide a one-time benefit increase after the policy has been in effect for 10 years. Answer: B. To automatically increase the policy's benefit amount to keep pace with rising care costs. Explanation: an inflation protection rider is designed to help the policyholder keep pace with the rising costs of long-term care services over time. This rider automatically increases the policy's benefit amount annually, often by a set percentage, ensuring that the policyholder will have adequate coverage even as care costs increase due to inflation. It is not about raising premiums or offering one-time benefit increases, and it does not relate to the purchase of additional coverage without underwriting. Question 22. Topic: Shared care rider. A shared care rider in long-term care insurance policies allows A. The policyholder to share that policy with a family member, such as a spouse. B. Two or more insured individuals to combine their benefit pools. C. One individual to receive care from multiple providers simultaneously. D. The policyholder to switch between different types of care services. Answer: B. Two or more insured individuals to combine their benefit pools. Explanation: a shared care rider allows two insured individuals, usually spouses, to combine or share their benefit pools in a long-term care insurance policy. If one spouse exhausts their benefits, they can use the other spouse's unused benefits. This type of rider provides flexibility for couples, ensuring that both have coverage even if one requires more care than initially anticipated. The rider does not permit the sharing of a single policy with others or simultaneous care from multiple providers. Question 23. Topic: Tax treatment of long-term care insurance. In Idaho, premiums paid for a qualified long-term care insurance policy may be A. Fully tax deductible regardless of income. B. Tax deductible only if the policyholder itemizes deductions and meets IRS limits. C. Taxable as income if the policyholder receives any benefits. D. Eligible for a state tax credit equal to the policy's annual premium. Answer: B. Tax deductible only if the policyholder itemizes deductions and meets IRS limits. Explanation: Premiums paid for a qualified long-term care insurance policy may be tax-deductible if the policyholder itemizes their deductions on their federal tax return and the premiums, combined with other medical expenses, exceed a certain percentage of their adjusted gross income. Idaho does not offer a state tax credit equal to the policy's annual premium, and benefits paid under a qualified policy are generally not considered taxable income. Question 24. Topic: Non-forfeiture benefit. The non-forfeiture benefit in a long-term care insurance policy ensures that a. Premiums are refunded if the policyholder never uses the benefits. B. The policyholder can retain some benefits even if they stop paying premiums. C. The insurance company cannot cancel the policy for any reason. D. The policyholder can transfer the policy to another insurance company without penalty. Answer: B. The policyholder can retain some benefits even if they stop paying premiums. Explanation: a non-forfeiture benefit allows the policyholder to retain a reduced level of benefits if they stop paying premiums, rather than losing coverage entirely. This feature ensures that the policyholder does not forfeit all benefits after paying into the policy for several years, even if they can no longer afford premiums. This is particularly important for long-term policies, but it does not involve premium refunds or transferring policies to other insurers. Question 25. Topic: Idaho Partnership Program for Long-Term Care. The Idaho Long-Term Care Partnership Program offers what key advantage to policyholders: A. Guaranteed eligibility for Medicaid benefits. B. Protection of personal assets equal to the amount of insurance benefits received. C. Full coverage of all long-term care expenses once the policy is exhausted. D. A state-funded premium reduction for low-income individuals. Answer: B. Protection of personal assets equal to the amount of insurance benefits received. Explanation: the Idaho Long-Term Care Partnership Program allows policyholders to protect a portion of their personal assets from Medicaid's asset recovery rules. The amount of protection is equal to the insurance benefits paid out under the policy. This means that if a policyholder exhausts their long-term care insurance benefits and needs to apply for Medicaid, they can keep assets that would otherwise need to be spent down to qualify. This program does not guarantee Medicaid eligibility or fully cover all expenses. Question 26. Topic: Alternate plan of care provision. What does the alternate plan of care provision allow in a long-term care insurance policy? A. Coverage for experimental treatments not explicitly listed in the policy. B. The insurance company to decide whether to deny or approve a claim. C. Flexibility to cover services not originally covered if agreed upon by the policyholder and insurer. D. The policyholder to switch from nursing home care to in-home care without penalty. Answer: C. Flexibility to cover services not originally covered if agreed upon by the policyholder and insurer. Explanation: the alternate plan of care provision allows the policyholder and the insurance company to agree on covering services that are not explicitly mentioned in the original policy but may be beneficial to the policyholder. For example, this could include alternative treatments or types of care that develop after the policy was written. It provides flexibility, but it is not a guarantee of coverage for experimental treatments or a way to bypass standard claim approval procedures. Question 27. Topic: Idaho Insurance Guarantee Association. In Idaho, if a long-term care insurance company becomes insolvent, the Idaho Insurance Guarantee Association will A. Pay all outstanding claims in full regardless of the amount. B. Continue to pay benefits up to a specified limit per policyholder. C. Automatically transfer all policies to a new insurer. D. Refund the policyholder's premiums if no claims have been made. Answer: B. Continue to pay benefits up to a specified limit per policyholder. Explanation: the Idaho Insurance Guarantee Association is responsible for continuing to pay benefits up to a specified limit if a long-term care insurance company becomes insolvent. The association does not guarantee full payment of all claims or provide premium refunds. There are typically limits on how much coverage the Guarantee Association will provide per policyholder, and policies are not automatically transferred to new insurers. Question 28. Topic: Bed reservation benefit. The bed reservation benefit in a long-term care insurance policy typically applies when A. The policyholder is temporarily away from a nursing home and wants to ensure their bed is available upon return. B. The policyholder is admitted to the hospital for surgery and needs home care services. C. The policyholder is switching from nursing home care to assisted living. D. The policyholder requests to reserve a bed at a new facility while waiting for approval. Answer A. The policyholder is temporarily away from a nursing home and wants to ensure their bed is available upon return. Explanation. The bed reservation benefit allows a policyholder to reserve their bed in a nursing home if they are temporarily hospitalized or otherwise away from the facility for a short period. This ensures they can return to the same bed without losing their spot. It does not apply to home care services, assisted living transitions, or reserving a bed at a new facility. Question 29. Topic: Elimination period in long-term care insurance. In Idaho, the elimination period in a long-term care insurance policy refers to A. the time period during which the policyholder can cancel the policy without penalty, B. the number of days the policyholder must wait before benefits begin, C. the period during which the policyholder must continue paying premiums before claims are accepted, D. the maximum length of time benefits will be paid out under the policy. Answer: B. The number of days the policyholder must wait before benefits begin. Explanation. The elimination period in a long-term care insurance policy is similar to a deductible, but instead of being a monetary amount, it is a set period of time, usually 30, 60, or 90 days, that the policyholder must wait after becoming eligible for benefits before the insurance company begins paying for services. During this period, the policyholder is responsible for covering their own long-term care expenses. It is not related to premium payments or the total length of coverage. Question 30. Topic: Coverage for pre-existing conditions. Under Idaho law, a long-term care insurance policy can impose restrictions on pre-existing conditions for up to A. 3 months after the policy's effective date, B. 6 months after the policy's effective date, C. 1 year after the policy's effective date, D. 2 years after the policy's effective date. Answer: B. 6 months after the policy's effective date. Explanation. In Idaho, long-term care insurance policies can impose a waiting period of up to 6 months for pre-existing conditions. This means that the insurer may refuse to pay benefits related to any condition that existed before the policy's effective date for a maximum of 6 months. After this period, coverage for those conditions must be provided if the policyholder meets all other eligibility requirements. This ensures that people are not denied benefits indefinitely due to pre-existing conditions.